Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending June 4th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is middle of the road. Let's kind of get into how we fared last week and let's talk a little bit about what I see coming up based on what the charts are showing me here. So if we just kind of come over here and take a look at the weekly sound bites, let's take a look at the index performance for the week. You can see in the U.S., all major indexes were in the green. I mean, barely, but they were all in the green. Year to date, solid in the green, with the Russell leading the way at 15.84%. And then slightly behind is the Dow, the S&P, and Nasdaq's bringing up the rear as we've seen some shift in market action out of technologies into more cyclical type stocks as the markets start to open again. If you look on the right-hand side, you can see valuations are still fairly rich. The forward 12-month PE ratio is at 22.52. And the dividend yield in the S&P is still at 1.38, same as last week. Treasury yields fell just a little bit this week. More on that in a minute, but it came down to 1.56. Spread between the two is still a positive 18 basis points, but it's still going to keep money in the equity markets. The VIX closed out the week at 16.42, so it was down 20 basis points for the week. Then you can see the best sector in the U.S. was energy, up over a whopping 6% for the week. Worst was healthcare, down 1.43. And then best performing sector so far this year in 2021, no doubt, is energy. Has been holding the lead in this race all year, every month, every week. Actually, energy's up 38.6% for the year. Utilities bringing up the rear, 5.07%. Now, if we kind of just take a look at the major indexes and the performance, trading volume is really light, but that should be expected as we go into the summer months. Okay. Um, really, the chief concern in the market price action right now isn't really the strong earnings growth, but the overheating economy that all this strong growth can bring on, and some of the supply chain disruptions that could force the Fed. A lot of money analysts believe in market price action, force the Fed to kind of scale back their bond buying or even begin the process of lifting interest rates. And that will really move the markets to the downside. Okay. I mean, over the past 3 months or so, we've seen average earnings yields rise over 7% annualized. Okay. And typically labor costs tend to be a lot more sticky than transitory supply chain issues. So we got to see how this thing plays itself out. Now, we pretty much wound down Q1 earnings. In fact, in about 5 or 6 weeks, we're going to start with Q2 earnings. But so far, a little over 495, 496 companies have reported out of the 500 in the S&P. On average, 50% earnings growth in Q1. And by the way, Q2 is going to come in even stronger. But just to give you an idea of the nature of the inflation worries and interest rates going up with inflation, just a complete 3% increase on where we are right now. And bond yields would take the U.S. spend on servicing our debt. It would move it larger than the entire defense sector. I mean, just really amazing. I mean, it's just totally amazing here. Hang on just 1 second, guys. So really amazing with all this interest rate, what it can do. So the Feds are really incentivized to keep rates lower, but I think the bond market's going to force this issue. Not so much this year, but clearly next year. Now, if we look at the economic data this past week, the monthly non-farm payrolls reports very closely watched. As the Labor Department reported employees added almost 560,000 jobs in May, somewhat below the forecast of 650,000. All right. We also saw labor force participation tick down by 10 basis points as well. And we did see the unemployment rate come in also. But, excuse me, I swallowed the wrong way, guys. I was just having a heck of a time. But what we're seeing, as I said a few minutes ago, is that less than stellar economic news is good for market price action, i.e., bad news on economic front can be good news for price action. Now, for those of you that have followed me for a long time, many of you have, since we in 2011, 2012, 2013, we had a long period, over a year or so, as we were anticipating the Fed rate hikes coming off very low rates. And we were in this period where good economic data was bad news for price action, for fear that it's going to force the Feds to rein in their stimulus and jack up interest rates. So we're in this same paradigm right now, as you saw. I mean, just this past week, you saw how the markets reacted to a very strong CPI number. The prior week, the markets fell a pretty good. I mean, the S&P was down 70 or 80 points real quick, right? And then on Friday, the economic data was not as strong as everybody expected. The markets just took off big time. So that's kind of where we are. Bad news is good news. Good news is bad news for the markets. Now, if we come over and we take a look at the U.S. Treasuries, um, in keeping with the bad economic data or less than stellar economic data is good for the price action in the markets, the yield on the 10-year Treasury also fell back this week. Okay. So, and that was following the May payrolls report. We saw the yields come in. We're seeing corporate bond market relatively quiet, investment grade bonds, very light trading volume. I mean, volumes are going to be light as we go through the summer months, but that also helped boost the market on Friday. Then, of course, over in Europe, shares are going up a little bit on an economic recovery. However, they are getting worried because next Thursday we get the central banks. They're going to ECB central banks are meeting next week to see what they want to do with their interest rates and talk a little bit more about their stimulus program, because every country is doing stimulus, from Japan, South Korea, China is pretty much slowing theirs down. That's why their markets are having a harder time of it. The ECB, they're doing a tremendous amount of stimulus. Great Britain is doing stimulus. In the U.S., of course, we're leading the pack as far as just printing new dollars. All of this is going to have to come to a stop at some point, and the markets are not going to like it. Okay, so the big issue for people trading, especially if you're short-term swing traders, things like that, it's going to be very choppy. And then when we do get signs that the Feds are going to start to cut, not just thinking about cutting, but actually cutting or reining in stimulus, the market's going to have a hard time of it. And if inflation comes back very hard, traditionally equity markets do not do good in an inflationary market. In fact, it could push the markets into a recession if the Feds are forced to cut stronger than they would like. So we'll see how this plays out. The same thing's playing out over in Europe too. Eurozone inflation increased 40 basis points in May from the prior months. Okay, it's above the ECB stated target, but close enough to 2% to give them some wiggle room. But they are meeting next week. Let's see what they want to do. Meanwhile, all across the European Union, they're planning on lifting a lot of their quarantine rules. They're a little bit stricter than we are here in the U.S., and they're going to start talking about introducing digital passports for travelers, primarily international travelers, starting July 1. So we'll see how that works out on whether you're going to need a digital passport for a vaccine or just proof that you've taken a COVID test, right? And now, of course, if we come over and we look at China, take a look at those markets. And by the way, I forgot to show you the world index performance. You can see pretty much in the green all of Europe, from Euro stocks to the FTSE, CAC 40, the DAX, all in the green. Year to date, everybody's in the green. That's a wild percentage for China, and it really should not say that. It should be more like about 3.42% is what it should say. But you can see in the Asian markets, from the Nikkei, China, Hang Seng, all in the red for the week. Okay. But everybody's in the green year to date. So, a very strong market. Chinese stocks are pulling back just a little bit. They've had 3 solid weeks of gains. And on the economic front, their manufacturing index rose to 52. It's the highest reading that we've seen as demand is starting to pick up across China. So, everything is looking good. But like I said, we've got this paradigm, this middle of the road economic data. As long as economic data comes out in the U.S. that's less than overwhelming, it's just mediocre or just at expectations, I think we're going to see price action continue to move higher. We may even have a blow off top. But the minute we see signs of inflationary data, I can guarantee you it's going to be an ugly day for the S&P. Now, every time we get that, the Feds will kind of march up to the podium and say something. Keep in mind, this summer, August, we're going to get the Jackson Hole, Wyoming confab where all the muckety mucks from all the central banks globally meet. Okay. And there's rumor and speculation that that's when Jerome Power Ranger Boom Boom Powell, our illustrious Fed chair, is going to start now talking about the Fed process of how they're going to go about cutting stimulus, right? They'll probably cut the monthly 120 billion that they're spending in quantitative easing every month. They probably won't touch interest rates till the end of 2022, going into 2023, but they may be forced to move that up. They're on record as saying they'll do what they need to do to stop inflation, but they're going to let it run a little bit hot. So that's going to create some conundrums for the markets as we get into 2022. Okay. So what I want to do, let me just show you a couple of different charts. First thing I'm going to do is I'm going to take you over and show you a chart of the E-mini S&P 500 futures. I'm going to show you a daily chart here of the futures first. I'm going to show you volume. Let me just get it over on the screen for you guys. So the screen will go blank for a second, and then it's going to come up for you. And what you're going to see how volume is really tapered off here. It's just really come down very strong. Let me just get this little adjustment here. So I'm seeing here that you guys are also seeing the screen. That's good. So you can see volume has come down dramatically. If you look down below, you can see here on this big move lower right here, you know, we had a lot of volume, right? We had a lot of distribution there. And then on this move higher right here, this red or this purple line is a 5 EMA of volume, and the blue line is a 20 EMA of volume. So anytime the purple line goes below the blue, we're running on average weekly volume that's lower than average. And you can see that while it's picked up a little bit, the purple is way down here, and I could just draw this line like that. You can see volume has come down a pretty good little bit. I mean, we did have a pretty good volume spike on Friday, and that was a solid move higher right there. And you can see how close we are to the all-time highs on that close right here. And you can see the red line, which is the 50 EMA, is providing pretty good support for the S&P right now. But that's going to be our first major test on the way down. I still am calling for a pullback sometime in July, August timeframe of 7 to 12, 13% area. And then we'll have another attempted run higher, and then if that gives it up, we'll come down even harder. But I can't see that. All I can see right now is we're starting to show a lot of weakness in this move up right here. Now remember, momentum can carry us up. I had called 41 to 4,300 as our high point in the markets this year. Now I expected it in Q4 of this year, but we're already at a high point of 42.38 on the futures. So that's not far away from my high point of 4,300 sitting up here. And I would not be surprised to see us just blow right through this thing and have the momentum carry us up to 4,300, possibly even 4,350, and then we won't see that the rest of the year. Okay. But that's kind of what I'm looking at on the charts. Now, I've told our members in our group we should not be surprised to get that number, because remember, momentum can last a lot longer than you can, a lot longer than you can, stay short, I guess. So that's a little bit about what I'm seeing here. Now I'm going to show you the same chart, but let's go take a look at the SPX, right? And the SPX is the cash index, and that's where you have the gaps, the opening and closing gaps and things like that. But I'm also going to show you, let me just switch the screen over here like this. Just get you over here. So the screen will go blank for a second, and it'll come up for you. But what I want to show you in this chart here, as it comes up, is the, okay, so now I'm seeing that you're seeing the chart. You can see down below, you got the MACD. We're setting up, folks, for a really good solid divergence here. We're starting to get it. You can see the 2020 closing price here. So this is the cash index. We got an all-time high of 42.38. We actually closed at 42.29. 89. So, just about 8 or 9 points away from our all-time highs. I think we'll take that. Once you get this close to all-time highs, price action just wants to take it out, just to show that it can take it out. But we've got a major divergence setting up here on this. And then just like the futures chart, you can see where the 50 EMA has provided support for the SPX cash index going all the way back to early March. And even in early March, we only had one day that we closed below and then went right back up again. And then you can see all of these touches in the 50 EMA, right? So, and look at the 200 EMA, guys. It's sitting right on the closing price of last year, right? Anything below that blue line, we're in the red for the year. Above the red blue line, we're in the green for the year. So again, we're up on the SPX a little over 12.5% up here. So a 12% pullback has taken us right back to this line here. And again, that would not surprise me at all to see that action. All right, just it would not. There's a fib node sitting right here as well. If I just swing it back to the E-mini futures and blow it up a little bit, you can see I got a 0.236 fib node sitting there. I've got another natural pivot point at 37.20, and then the low price for 2021 sitting at 36.52. So we've got a lot of support down in this area. This would take us down anywhere from 12 to 14% below. Again, guys, I would not be surprised to see that if we do get higher inflation by CPI data, and then that is backed up by Boom Boom Powell, our Fed chair, coming out in Jackson Hole, Wyoming in August timeframe, or we get word of that speech that they're looking at cutting back QE. That married with higher inflation gives us a 10% pullback in a heartbeat. Remember, the S&P can fall 100, 150 points very easily. And you'll see the Dow down, a couple of thousand points in the week, during the week. So I just want everybody to be aware of this. And that's kind of what I'm seeing so far. Now, if this changes, I'll let you guys know in our weekly roundup. Members, you'll be the first to know, obviously, because we track it day to day. But this is just something that we're looking at here. Okay, and our goal is not to try and guess what's going to happen over here, but just assign probabilities to it and then play the probability. And it usually works out longer term very well. Now, if we look at Nasdaq, Nasdaq hadn't gone anywhere since early February. Look at this movement here. It's up and down, going all the way back here to this prior resistance point back in late January. We're just barely above that late January price today, and we haven't gone anywhere. Now, we did make an all-time high back in end of April, coming into beginning of May. We just eked out an all-time high here, and then we had that big pullback on that CPI data, and it really scared technology. Keep in mind, when interest rates start going up, technology will not like that at all. Technology is not a place where you want to be when interest rates start rising and we start to see inflation in there, because they just really get pounded harder than most. And if you don't believe me, just call up XLK or any tech stock that you may be holding or watching, and then go look at what happened to it, a few weeks ago when we had that CPI data come out, and it talked about higher interest rates, or higher inflation rather, and it spooked the markets. Technology didn't like that at all. So anyway, we got that. If we look at the FANG index, you'll see it looks exactly the same. Just a lot of chop. We did regain the 50 EMA, but it just does not look that good to me. Okay. Now, if we look at the tracking stock for China, you can see we almost went into a bear market in China towards the end of March. Okay. I mean, we're just barely over the 2020 closing price. And the reason why China is doing so bad is they came down very hard on the technology stocks, and they've been pulling back some of their stimulus. They're doing all the right things, right? And this is kind of what we're going to have to look forward to when that starts happening here as well. Now look at the Russell. Even though it's leading the way, we've just been in a big circle jerk going all the way back to early February, just down, up in this tight range. We will break this range. The odds right now, near term, favor breaking it to the upside. And then as we go towards the end of summer, coming back down for a pretty hefty little pullback. All right. Now I will show you, and I show this to our members, and this is one of the stocks that you want to be long in. And it's just as a just for your weekly roundup, folks. that watch, this is one that you want to be long. All right. You want to be long Russell 1000 value. So now this is the Russell chart, right? Up, down, up, down. It's just flat across, flat as a pancake. You could draw a box around this and say we've been in this box. Now look at the Russell value. This thing has just got a great looking chart, right? It's just straight up. Every time we test the 50 EMA, it's up. You want to be long Russell value. So that's the old value versus growth equation. This shows that money is rotating into value. Now, this is small cap value, right? Because the Russell 1000, small cap value. But this is, and the ticker is India Whiskey David, IWD. It's a really good one. It does not look like any of the other stocks. It's very solid. And you can see once we started coming in big time in early November of last year, it just took off and never looked back. Okay. So it's just one that you definitely want to have on your watch list. Now, when we do get this pullback, all of these stocks that I mentioned are talked about, are going to talk about, are going to pull back. So you got to be ready for it. But at least have it on your watch list and you can sit on the sidelines and then pick it up at a better price when it starts going higher. Okay. If we look at volatility, well, you can see here in the VIX, it fell pretty good on Friday, and we're in this yellow zone, which is mostly choppy markets, right? Anywhere from about 15 to 20 in the VIX. Generally, you get chop in the markets. Then if you get over 20, you get into a little bit more of markets that can go down really fast, very quick, right? And then if you get into the red here, you get into more of a 10% pullback and you get into correction territory. And then obviously in the black, you get into black swan territory, right? I mean, that's kind of where you are, obviously in the black. But right now, we're kind of hovering around these lows around the 16 area. So it's just choppy markets. And then if we come down here, it's going to get quiet. I do not believe the summer months. It wants to drip down here, but anytime we get any inflationary data, we're getting CPI data, anything that comes in stronger than expected, you can expect the VIX to pop up. As you can see here, in May, it drove the VIX all the way up to 28, almost 29, right? In a very fast down market. That's when we got the last really bad data on CPI. It came in at 4.2%. Scared the children a moment. Markets moved down pretty hard in second week in May, and then it's just been drifting lower. So we haven't really seen that kind of number again. But if we do, that's all it takes. And you could see we went from around the 16 level all the way up to the 28 level, right? In literally 2 or 3 days, and boom, we were there. So just understand, you've got to be careful in this good news is bad news market environment, because you can be in the best stock, have great profits, and all of a sudden in 1 or 2 days you're underwater. And be careful with it. Okay. Again, if we look at treasuries, we're up around that 50 EMA again. Right? You can see, and as I've said, anytime we get up around the 50 EMA, you want to be selling into it. So I want to see where this goes. Notice it moved up, which meant interest rates moved down on Friday. Why did interest rates move down? Because we got a lackluster jobs number. Okay, it was a very lackluster jobs number. It was 559,000 jobs in May. They were expecting 650, almost 100,000 more. Some of them were even saying it should be 7 or 800,000, but it came in lackluster, right? Primarily, I mean, we know the reasons why, because a lot of governments, a lot of states are paying people to pretty much stay on the couch instead of go work, which is the wrong prescription in my mind. But that's what they're doing. So it's you've got the private sector competing against the public sector, the government, for bringing people in. So the private sector is having to pay more for these people, and hence that's why we're getting the over 7% annualized growth in wages, right? And that's going to be hard to take away once you're paying someone a little bit more. It's going to be hard to take that money away from them. So that's going to help speed up the process and the evolution of inflation coming. But that's that. And obviously with bond market moving up, if you look at the 10-year interest rates, you can see it broke the 50 EMA and came down, right? So I don't think it's going to go much lower than that. It's probably going to kind of find a bottom. And then it's going to start working its way back up. I've got a projection probably before the end of the year of at least 1.88 before we get into the end of the year. Okay. That would be my target, or at least we're going to find a lot of resistance around the 1.88 area for interest rates. All right. And members, we'll cover in detail the currency market this Sunday evening. There's going to be some interesting plays here. Gold, as you guys know, we're already playing gold. All right, it broke out of this downsloping trend line. It moved up above 1800. It moved above the psychological 1900 barrier, and then it's pulling back. But this pullback should be bought, not sold. I think gold is going to move higher. All right, you can see it just, there's no divergences in here. It's digesting. This was just a profit taking mode. We may run sideways for a bit, and then I think we're going to take off again. Same thing with silver. If we look at silver, silver is trying to break out of here. It's a little bit choppier than gold, but I do believe it will eventually break out, and the upside for silver is going to be over 30. Upside for gold to be over 2,000. All right, I can see that coming up. Same thing with copper. We're playing copper, as you guys know if you're watching us in the weekly roundup these weekends. Copper is one of our metal plays of choice. We love it. Oil. Oil made new highs, made new 2021 highs right here on Friday, 69.76. Now I'm on record as saying that I don't see it. If it does get up to 70, it's not going to go much higher than that. Okay. And then it's going to be kind of sandwiched between there and probably not much lower than the mid 50s. So it's about a 15-point range that we're going to see. You can see the 50 EMA buyers are stepping in the oil market. All right. Now, when it made this first run here, I was having our members fade this move to the downside. But now that we're moving up, members, I've got a list of about 12 to 14 stocks, not in the energy sector, but some are, that we got to look at going long on. All right. And we'll probably use our new strategies I introduced to you on how to do that. So for those of you that have small accounts, you don't have to come in here and buy a $300 stock. With some of the strategies that we're using options, you can do it and minimize, almost eliminate, but sometimes not the case. But in many cases, you can eliminate downside risk while being bullish, which is a great thing, right? So oil, that's what we see. Nat gas. Nat gas is sitting here over 3. 3 is kind of the magical number. Every time it gets up over 3, the higher it gets, the more I'm going to want to short nat gas. But we've got some plays in the natural gas to energy area that I'm going to introduce you guys to also this Sunday evening. I think you're going to enjoy. We're going to look at plays in that also. Okay, so that's a little bit about what we got going on, folks, for the markets. Net, the chief concern right now in price action isn't the strong earnings growth. It isn't how these companies are doing. It's more about overheating economy, which could in turn force the Feds to rein in their bond buying programs, possibly begin the process of lifting interest rates. That's the chief concern. So we're in a good news for economic data is bad news for the markets. Our bad news for economic data is good news for price action in the markets. We got to watch that very closely and see how this thing is going to spin. All right, folks, I will see you next weekend. Members, I will see you tomorrow night. Got some really cool stocks to take a look at. Take care, everybody. Ciao now.